G'day, you nines. I want to start with a couple of recent news articles just to introduce this idea that there's some relatedness between businesses, the economy, and what's been happening and continues to happen over the last couple of years with COVID-19. There are two articles I've come across. It's actually Australia Day that I thought really were very interesting in the way that they show these links. Please don't feel that you have to learn or take away anything from it. It's just to make you a little bit familiar about some different things. So we start on the ABC website, always a reasonably reliable source of information, I would have thought. The headline is that inflation is not out of control, but interest rates may have to rise this year. I think we're going to focus on a little bit is relationships, different relationships. And this is talking about one of the relationships here between inflation and interest rates in an economy. Let's start with inflation. Inflation refers to the fact that prices tend to go up over time. The costs of goods and services tend to go up over time. Let's have a look at the article and jump into this. Inflation is not out of control, but rising. So Australian consumers saw prices rise by 3.5% last year. That's inflation. So something in the average at $100 at the start of the year had risen by 3.5% to be $103.50. It was the fastest annual increase in prices in years. So what does it mean? It means that Australia hasn't avoided inflation increasing, and we're seeing inflation increase overseas as well. Now we come to this link between inflation and interest rates. There's a mechanism in Australia where the Reserve Bank of Australia sets a cash rate, an overnight rate, that influences the rate at which the banks we see around the place like Commonwealth Bank, ANZ, Westpac can borrow money. That cash rate at the moment is 0.1%. It's tiny. It has never been lower. But there's talk that that rate might rise. And let's have a think about what happens. If banks have to borrow more for money, they have to charge more for interest. For example, the adults at home might have a mortgage on their house. If interest rates rise, they'll have to pay more for the mortgage and they'll have less money to spend on goods and services. Similarly, businesses have often borrowed money for different assets, maybe for the property that they're working from, maybe for some equipment that they use. And so if interest rates rise, more of the money will go towards that. Plus, if households have less money to spend because they're spending more on their mortgage, their customers have a little bit less. So why would you raise rates? You would say, well, it's because they're trying to keep inflation at between about 2 and 3% on average. They'd like to see that goods are going up in price, goods and services going up in price at a steady pace, but not too much. So let's have a little bit further read. Most of the prices that increased last year, most of the inflation was from pandemic-related economic disruption. So here we're at COVID-19. So some of the things were the higher cost of fuel. And as you drive around, as I drive around today, I see petrol's like $1.80, $1.90 per litre. That's pretty expensive. And also there was freight costs were more expensive, which feeds through to a whole lot of things that end up on supermarket shelves, shopping shelves. The other thing that wasn't talked about in this article, here it is now actually, is this large increase in the price of building materials. So suddenly it's becoming a lot more expensive to renovate or build a new home. And there's some evidence that because people over the last 2 years haven't been able to travel and spend money on things, they have spent more money on their home, on doing home improvements or upgrading a home. So, according to the Bureau of Statistics, high levels of building construction activity and shortages of material and labour have meant that there's been a really big increase in the price of new houses. There's a graph of the change in price movement. So the price movement in new houses, we can see it increasing over time. So let's have a look at some of this commentary on this. So Australia's high for Australian standards, but there was a lot of inflation around the world. They're saying inflation in the United States was high, UK and Canada. So now they're saying that the overall estimate of inflation puts it around about that 2 to 3% target that the Reserve Bank is targeting. And the question will be, should interest rates rise and when will they rise? There's also a link between prices and wages. So as prices go up, people need to be paid a little bit more so they can afford more goods and services. So that's another element of the relationship. We've also got the Australian newspaper here, and their frontline article was rate rises loom after inflation. I wanted to add a couple of things from their article, just thinking about this idea that there have been impacts from the pandemic that have pushed the prices of some things up, and now we're looking at the way inflation, the measure of average prices for consumer, links to interest rates, and whether interest rates may rise and the effect that has on households and on businesses. It's a very complex relationship, but they talk about a couple of things. They reiterate that the biggest driver for the result was the increase in inflation were the jump in price of new houses, new dwellings, and also a big lift in fuel prices. And as I said, you drive past petrol stations now, you're probably seeing $1.80, $1.90. And the second thing that happened here, they looked at something else. One thing we're going to do this term is play the ASX game. So what impact has this higher than expected rate of inflation had on share prices? Well, it says that on the Tuesday, which was the day of the announcement, investors wiped $60 billion off the value of Australian shares. It meant that the average portfolio of shares fell in value by 2.5% in a day. So if you had maybe $100,000 invested in the share market, if it was an average set of shares, that would have fallen from $100,000 to $97,500 on that one day. But of course, shares are very volatile, something we'll learn as we go into the share market game there. And just a couple of things from the second page of the article. This is the comment from Ernst & Young economist. Ernst & Young are one of the big accounting firms, and most of these big accounting or financial firms have economists that they want getting their name into newspaper articles because it provides some publicity for their business. And the economist, Jo Masters, she makes the comment that while there was this inflation, Omicron, so that's the current COVID-19 variant we've got in Australia, Omicron has pushed Australia into a shadow lockdown and confidence has taken a hit. So while prices have gone up, her point is that now everyone's being a little bit more cautious, less people are going out, and so there's less confidence in the economy and less economic activity, less pressure on prices. So maybe she's saying inflation might continue to go up and perhaps their moves on interest rates won't come so quickly. So look, a fairly complex set of relationships, but interesting to see a couple of news articles looking at the very sort of things we're going to be looking at.